Good morning, everyone. Thank you, Andrew, Vicky, Matteo, and Viola, and Carlos, which will be moderating the next roundtable. It's titled Portfolio Alignment Methodologies Against Climate Change. Welcome to all of you, and please feel free to unmute yourself, your microphone, and your camera. Carlos, may I give the floor to you?
Thanks a lot, Andrea. Is everything all nailed down in that sense?
Yes, it is all okay.
Perfect, fantastic. So yeah, thanks a lot, Andrea, and thanks a lot to Spainsif to giving me the opportunity to moderate this very interesting panel session. So good morning, everyone, and welcome to the summer university course of Spainsif, which this year is devoted to the climate emergency and what investors and corporations can and should do about it. It is a pleasure to have you all here on this opening panel, the first of 4 roundtable discussions that you will have on this summer course, which is in partnership with the IE University. My name is Carlos Martin Tornero. I'm a senior reporter at Responsible Investor, which is a leading newswire and global publication on sustainable finance and ESG investment in London. We have a fantastic set of panelists today to take a look at portfolio alignment methodologies against climate change. Yes, this seems a bit of a mouthful, but that's only in appearance. Don't be scared by the name of the topic. The speakers today will show us that portfolio alignment is a timely issue and a critical tool, together with engagement with investee companies. It is one of the main levers that investors can use to decarbonize the assets they hold. The COVID-19 lockdown has brought us unthinkable images, for instance, Venice canals running clear, and even dolphins being spotted there, people in India seeing the Himalayas for the first time in decades, and even in Madrid, the skyline being totally clean as the toxic smog above Madrid, or what the locals call the pollution beret, disappeared during lockdown. But the climate emergency is not going away as we head towards a new normal, whatever that new normal means. And let's not forget that the normal before the pandemic wasn't the right one. So investors, that means that investors still need to aim for Paris-aligned portfolios, meaning to achieve net zero emissions by 2050, which is not only a matter of risk and return for them, it is also an imperative for those who claim or aspire to be responsible investors. So I think enough of me. Let's. I don't want to take up time of the panelists to give us their top line thoughts. I'm going to introduce our 4 speakers briefly now. We've got Andrew Black, who is a climate specialist at the Climate Risk Center of MSCI. Very welcome, Andrew. We've got as well Vicky Bakshi, Director Analyst at the responsible team of BMO Global Asset Management, Canadian firm with more than 700 billion Canadian dollars under management. Matteo Brezza, Account Manager, Investor Engagement at CDP, and Viola, Lutz, Associate Director, Head of Investor Consulting Climate at ISS ESG, the ESG house, more than proxy advisor, right? ISS. So thank you all for being here, and the format that we will have, it's a 5 minutes presentation that of each of the panelists, and then we will have a Q&A for about I guess possibly 20 minutes or so. So yeah, thanks a lot, and I'm going to put the task first to Andrew. Thanks a lot.
Great. I hope you can hear me. So buenos dias, everybody. I'm going to walk you through something called climate value at risk. Climate value at risk is a new approach to quantifying climate risk in investments. What I'm going to do is to specifically speak about this, but I just want to quickly mention to you that actually MSCI has a whole suite of sort of climate change metrics on investable companies, on different asset classes and so on. So the CVAR, as we call it, is just one piece of many, and I think it's a very interesting one, and it's one that we see a lot of interest in. So that's what I wanted to speak about today. One important thing for you to understand is really that this is a forward-looking metric, and this takes into account scenario analysis. Scenario analysis is a very kind of hot topic right now. We're seeing a lot of interest from regulators, from central banks, and actually this means that it's really focusing on return space. So it's really a kind of a risk metric, and it's a decision-making framework that allows for investors to really start to quantify and understand the impacts of climate change. So it's really moving forwards from this concept of carbon footprinting. Now, in the past, a lot of investors were using carbon footprinting just to talk about their climate risk, and actually these new tools and solutions are much more comprehensive. This one looks at the opportunities from climate change, green revenues, low carbon opportunities, as well as the risks that we all know and are talking about. So in that sense, it's very much a forward-looking metric, although carbon footprinting. And if we just move on to the next slide, it's very closely aligned with the TCFD recommendation. So this is a really big driver of what's going on at the moment with portfolios, with investors, with alignment. So the TCFD actually highlighted the work of MSCI's Climate Risk Center when it was formerly Carbon Delta, where I used to work. As actually being kind of an innovation in the market. And actually what we have here is we have on this circle on the right hand side, all of these different wedges, we have a model that specifically quantifies the data in each one of these areas. So we have a model on policy risk, we have a model on technology opportunities, and also on physical risks and opportunities. And these terms are used by the TCFD, and it's firmly embedded in how we've looked at this kind of risk, and how we make this risk understandable for investors who maybe don't always have a good and sound understanding of climate change and the complexity and the uncertainty around it. So part of what we're doing here is we're taking a big data approach. We're using a lot of kind of fintech methods to really start to quantify and allow our investors to understand exactly what is happening from climate change. So if we just move on again to the next slide. I just want to show you very quickly some information around the data itself, because I think the data is very, very interesting here. So what we're actually doing is we're doing a lot of complex climate modeling, and we're using new data sets. So these data sets have not been traditionally used by investors to date. So I'm not going to go through every single aspect on the page, but just to demonstrate to you that the climate value at risk metric is a hybrid approach. So it's really, this is giving you a flavor of the data input. So it's something like 60 different data points feeds into producing this metric. We're very transparent on exactly what. So it's a kind of a combination of top-down and bottom-up data. The things that I think are really interesting to highlight today is the fact that we have very detailed and rich facility and locations data. This is driving the analysis because we really understand on a company level what's the impact going to be on a company's facilities from climate change. So these extreme weather hazards, the floods, the wildfires, the heat waves, how do these impact the company's ability to generate revenues in the future under different scenarios? And we also look at patents. These patents are used to start to generate an understanding of potential green revenues in the future. The patent information is very, very interesting, and there's a lot of discussion about these data sets, and I think it's really, really fascinating. We can actually forecast potential green revenues from up to 400 different technologies that companies may be investing in. We also use NDCs. This is the so-called nationally determined contributions. So each country is submitting to the Paris Agreement a kind of breakdown of what they will be introducing into law and how they're going to ask different sectors of the economy to reduce emissions. This is a very important aspect of what we're doing. This is kind of at the back end, and we're really quantifying these NDCs. We've also touched on this extreme weather data, but this is coming from our collaboration with leading climate institutes. So these are research institutes. They work with the IPCC themselves. The Potsdam Institute for Climate Change is a very big, well-known one. We are using their data. The latest academically peer-reviewed climate data is feeding into the model. And last but not least, we have the scenarios and we have these integrated assessment models. So not to be too complicated, but these integrated assessment models are really the engines driving forward this. They take different fields of data, different data sets, they bring it together, and they're allowing us to actually start to output costs, carbon prices, things like this. It's very, very exciting what's actually happening here. If we move on to the next slide, I'm just going to walk you through this works. So when we translate climate impact costs, it's a little bit of a complex process here, but really what we're doing at the beginning is taking the impacts of climate change. So I've talked already about, we've got extreme weather hazards, we've got floods, we've got heat waves, these kinds of physical events. But we also have a change in policy. So if a government is going to introduce, let's say, net zero policy by 2050, as many European countries are doing, what is that impact on a country, on a company operating in a country? So how exactly will that quantify and translate into costs for that company? So that's really the second stage that we're doing here. We actually need to say, so what if there's a heat wave? So what if there's a coastal flooding event? We really calculate what the cost or profit will be on each company facility, and we aggregate these costs across all facilities in our database, and we start to aggregate these over time to produce a time series of costs. And what's very interesting about that is that actually using these different scenarios with different assumptions and different carbon prices, we can start to then see how these costs increase into the future. And actually understanding what those future costs might be for a company on the physical and the transition side, we can discount those costs to produce a current value, a net present value of those costs. And this allows us to essentially say, okay, these are the future costs of climate change, which the market has not yet priced in to the security valuation, to a company's valuation, or indeed for a portfolio. And actually this allows us to produce a climate stressed asset valuation here. So what we're really doing is we're taking this issuer level data, we're quantifying the costs, and then we're actually seeing how that feeds into a kind of a valuation approach. So investors are most commonly familiar with the end of this process, the valuation aspects. They're not so familiar with the inputs, the climate data. So that's what we're really bringing to the table. It's a new kind of stress testing capability that very quickly, quantitatively lets them calculate climate sort of risk across the portfolio. The last two parts of the process is interesting because we cascade the costs down to the level of individual securities. So we can tell them, okay, if you have a more of an equities portfolio, this would be the risk. This would also apply for fixed income instruments and real estate. So we're actually starting to expand this climate risk assessment across different asset classes. And then we can aggregate upwards to the level of an entire portfolio because everything is done through the lens of either a cost or a profit. So we've gone from, very different data points and to actually quantifying into those costs. So if we just move on to the next slide. This is just showing a little bit what I was talking about. So actually it's a very granular data set. What we're really taking is this issuer level analysis and breaking it down into different securities. So we can really provide investors with an understanding on the equity risk, the debt risk, and so on. And I think that's something that people are very excited about. Traditionally, ESG metrics only work at the level of an issuer. So this is something that we've had a great deal of interest on. And if we just move on to the final one. This is something that I wanted to quickly talk about as well, because this is actually very, very interesting for for investors. In terms of portfolio alignment, we can very quickly help them understand whether their portfolio is aligned or not aligned with the 2-degree world, with a 1.5-degree world. In fact, we can very quickly and easily quantify this using something called a warming potential. And you can see here 3 different examples. MSCI World in the middle is obviously analyzing the index of MSCI World, and this is based on the individual constituents. Your portfolios come out between 4 and 6 degrees, which is clearly very, very, very hot. And then clean tech portfolios tend to come out very low. What's interesting here is that most portfolios and most companies simply come out too hot in terms of a pure emissions intensity perspective. So this is quite different from the previous thing I talked about, which is about risk. This is really about alignment. And many investors are very interested to be aligned to 1.5 or 2 degrees. So we can actually allow them to do this. So this is something that we're also working very hard on. Thanks very much.
Thanks a lot, Andrew. Very interesting presentation. And now it's the turn of Vicky, please. Welcome.
Thank you very much. Just checking you can hear me okay.
Yep.
Great. Okay, thank you very much for the introduction, Carlos. And I'm going to build on some of what Andrew's said there. So first, I'm going to give a perspective of what BMO Global Asset Management's doing in a moment. But I wanted to take a bit of a step back first and talk to you about an important initiative that we've been involved in. And really the purpose of this initiative is picking up on something that Carlos said right at the beginning, which is that there's a lot of investor interest in this idea of Paris alignment and moving our investments towards net zero by 2050. But there isn't a lot of consensus on what that means. And when you start digging into that question, it's not straightforward to say whether an equity portfolio or a real estate portfolio is actually Paris aligned. That's a more complex question than perhaps it first appears. And even if we can agree on what it means, there's a whole range of approaches and methodologies, some of which you're hearing about on this webinar today. So an initiative that we've been involved in has been led by the Institutional Investors Group on Climate Change. This is a great organisation that brings together European institutional investors to make progress on climate change through public policy, corporate engagement, and initiatives like this, which are basically us grouping together to figure out how we crack some of these tricky problems, such as defining Paris alignment. And this particular initiative, the Paris Aligned Investment Initiative, was set up with this purpose of developing definitions of Paris alignment. So we're all, as investors, talking about the same thing, to analyze and compare some of the methodologies and approaches that have been developed, not just in listed equities and debts, which is important, but of course, many investors have investments in other asset classes too. So it's tackling other asset classes, as you can see here. And also to try and test that out on some real world portfolios to say, well, we might talk about this Paris alignment thing, but let's take an actual portfolio and see what that looks like, a bit like the examples you just saw from Andrew there. And trying to build some consensus about that. We're not necessarily all going to agree and all have the same methodology. There's a lot of experimentation going on, but at least let's not be talking at cross purposes with each other. And there's been 70 of the IGCC's members participating in this. I've been personally involved in the listed equities and debt one, and we've got colleagues who've been working hard on asset allocation, which is a whole other set of issues there that are interesting to talk about. What I wanted to do now, basically the reports from this initiative is coming to the point of publishing some reports on these 4 areas in the coming weeks. So I really encourage you to look out for those when they come. But I wanted to give you a bit of a heads up of the key findings that are coming out of listed equities and debt. And then I'll talk for a couple of minutes about what BMO Global Asset Management is doing in line with those findings. So can we move to the next slide? So as Carlos was saying right at the beginning, a Paris-aligned investment strategy. What the working groups talked about is one that's aligned with this idea of global net zero emissions by 2050. We don't know exactly what is required in terms of emissions trajectory to get to 1.5 degrees, but that's sort of roughly where the scientific consensus lies. And that's what we've defined as Paris-aligned. And the key thing here, and what's come out of the discussions from the working groups, is that you can't use a single metric to say if you're Paris aligned. As Andrew was saying, it's not just as simple as taking a carbon footprint and reducing it down to 0. There's more to it than that when you think about the investment point of view. So the report sets out these 3 steps to understanding and assessing Paris alignment. So first of all, it's about defining the pathway. Because if you look at reports such as the report from the Intergovernmental Panel on Climate Change, there's more than one way to get to net zero. You can go really quickly now and then be able to ease up later, or we can take too little action now and then have to make a very, very sharp correction later. And there isn't time right now to go into what the different scenarios are, but I think you'd be aware there's various different scenarios, both for the sort of energy transition and also for physical risk, particularly those put forward by the International Energy Agency and the IPCC. So I think investors need to be familiar with what those scenarios are. And one key point in the definitions is this isn't just about decarbonising portfolios. Of course, that's important, but really the investment in climate solutions has to be part of this assessment of Paris alignment. And that's sometimes been missed out as investors have talked about this in the past. I saw something from the International Energy Agency and the International Monetary Fund, the IMF, about a week ago, saying as we come out of the coronavirus crisis and we try to reflate our economies, they're saying there should be $3 trillion of investment in carbon and climate solutions over the next 3 years. So investors need to be a huge part in that. And we can't just look at taking carbon out of our portfolios. We need to be looking at putting solutions in if we genuinely want to achieve net global zero emissions by 2050. So defining the pathway is about understanding how we get to 2050, what is necessary building blocks of that. Then we get to the portfolio level, assessing the issuers. So within a listed equity or bond portfolio, what have we got in there and how do they look? And again, drawing what some of Andrew said, it's not just one indicator. There's sort of 3 key areas that the working groups have been talking about is, yes, we need to look at historical carbon emissions. So that's your kind of carbon footprint, scope 1 and 2, hopefully scope 3 as well, so that we can sort of understand where we are now. The future indicators is that idea of, for individual companies, are they on the right pathway to 2050? So we've got this sort of global 2050 pathway. We then can figure out what sectors need to be able to do. So what does the electricity sector need to do? What does the mining sector need to do? And then you can bring that down to the company level and say, well, are individual companies aligned with that pathway that their sector needs to be taking in order to get to 2050? And I'll talk in a moment about some of the indicators that we're using to try to assess that. And then, as I said, the percentage of revenue from climate solutions being an important part there. And a key reference point here, which we've now got, is the European taxonomy, of course, and assessing alignment, the exposure of companies' portfolios to those solutions. On the future indicators, one thing in the, as again, this is a draft, just to sort of say, draft that we've been talking about is classifying companies. So we're talking about classifications for an individual company. Can we say whether it's aligned now, it's transitioning towards alignment, so it's sort of out now and outside of where it needs to be on that pathway, but it's moving in the right direction. Perhaps it's got a net zero target. It's not aligned, so we're not thinking that company's aligned with 2050 net zero. Although some companies that we think we might classify as neutral. So these are companies that are not in highly carbon intensive sectors, perhaps sectors like some of the consumer goods sectors, where we perhaps say, well, we'll classify that as neutral because it's not making a big impact on our climate risk. And so once you've got that assessment and those metrics, the next step is then alignment. Clearly redirecting investment is one, so you can make an exclusion-based approach. We've got some of our funds have a complete exclusion of fossil fuel reserves. It might be more subtle than that, and it might be a tilting approach, but sort of orientating portfolios. But stewardship is really important here too. And one of the discussions that we've had in these working groups is, well, we can buy and sell a share, we can buy and sell a bond. It doesn't change an awful lot in the real world. It doesn't actually directly lead to decarbonisation. But if we can talk to a company and we can get that company to commit to net zero and to take steps in order to get there, then we've really changed something in the real world. So for those companies that are assessed as not aligned in that previous category, it doesn't mean we necessarily sell them straight away if we're aiming for Paris alignment. What it might mean is that we have intensive engagement with that company. We say you can only stay in this portfolio if you become Paris aligned, put a time scale on it. If they don't respond, then maybe it's time to sell. So just for the last couple of minutes, I'll talk about sort of using that sort of structure and framework, the kind of actions that BMO Global Asset Management has taken. And really, we've sort of taken, I guess, a kind of a modular approach in that we want to have different approaches to different parts of this. We really want to be able to make sure that all of this information is something we understand. It's not a black box. We really want to understand what the assumptions used are so that we can most usefully use it in our investment analysis. So fundamental to us is that our analysts, when they're doing their research, can take this information and figure out what does that mean for their valuations. So to run through very briefly a few things we're doing, thinking about those different future scenarios that I mentioned, we've been doing some stress testing work. This is something that's been very heavily pushed by regulators. It's something that our risk team are looking at, and there's some scenarios that the Dutch Central Bank put out a couple of years back, which we've used to really look at the worst case financial impact of different financial scenarios. Then focusing on that alignment question, we look at historical carbon emissions. We've got that as a sort of standard part of our process, looking at carbon footprint, scope 1 and 2. On the future indicators, not time to go into detail now, but I would recommend people take a look at the Transition Pathway Initiative and also the Science Based Targets Initiative. The TPI, Transition Pathway Initiative, is something that was set up in partnership with the London School of Economics and is doing exactly that work I said, looking at companies, looking at how they fit on that sort of sector pathway, the sort of glide path to 2050, and assessing whether or not they are aligned, as well as looking at some of the kind of management quality indicators of climate change. So it's a great sort of free resource that's available. And solutions. So we focused up to now on mapping our investments against the 17 Sustainable Development Goals, which of course include Goal 7 on clean energy and Goal 13 on climate change. And we'll be looking to further develop that as the taxonomy comes through. And then on ownership, we've published a climate engagement approach. So we've been absolutely explicit. We want companies to align with Paris. We've been very open about that, joined in a Climate Action 100+ initiative, and have been pushing companies to align their business plans. But also I think with engagement, it needs to have teeth. And one thing we've been doing is using our vote to vote against laggards at company AGM. So really trying to use our investment points to influence change. I'll leave it there. There's plenty more we could talk about, hopefully in the Q&A, but also I do encourage you to look at the Institutional Investors Group on climate change and the work that they've been doing. Thank you.
Thanks a lot, Vicky. Matteo, your turn now, Matteo. Thanks a lot.
Thank you, Carlos, and thank you, Andrew. Thank you, Vicky, for proceeding, and I will build on top of basically what you guys said. And do you guys hear me all right? Because I've been having a bit of a glitchy connection.
Perfect.
Okay, that's good. So yeah, also Carlos, like just a quick one, like based on what you were saying before on the Dolphins in Venice. we actually had Dolphins in Trieste, which is my own original city, and we want to keep it that way. I mean, we never saw dolphins ever, and we want to keep it definitely that way. So yeah, potentially, you know, some of the discussions of today could lead into that direction. Anyways, building on top of especially what Vicky was saying on you know, the power of engagement. So what I do now is you know, detail in a nutshell what CDP is doing, and in fact, Andre, yeah, perfect. So basically, what CDP is doing, like what CDP is essentially, and then I would move into portfolio alignment strategies and tools that CDP is proposing on with the final objective of empowering engagement of investors at the end. So what CDP is essentially we are a global environmental disclosure platform. So what we do since 20 years is we are collecting environmental data from companies, and you know, our theory of change is essentially that what gets measured gets managed. So we want to measure the environmental impact of companies, and the way we do it is actually on the next slide. The way we do it is we use the power of investors, so the authority of investors, the ownership of investors, to then go to companies and ask them for environmental disclosure. We do this across 3 main programs that we have. Climate change, so it would be the, let's say, the carbon program, water security, and deforestation. So substantially what happens is that every year we target thousands of companies globally, and we collect data from those companies. And the investor part, so the engagement part, the collaborative engagement part is vital for this, because if it be just CDP going to, so we're talking in Spain, so we're going to Iberdrola to ask for disclosure on environmental topics, they would probably send us away really quickly. But if we would have investors, if we have investors which provide us with the authority to then go to Iberdrola and ask for an environmental disclosure, then Iberdrola responds. So that's the whole mechanism of CDP. And what we do with all of this data that we collect is we feed it into the investors that supported the authority to support the CDP authority, and then we provide the data actually externally to the financial markets, to market providers, to index providers, to data providers, research houses, and to whoever actually needs this data and wants this data. If we would go on, Andrea. So basically, this is just a snapshot of, just CDP Europe. So in terms of like how many companies are actually disclosing through CDP. So we have around 2,000 companies which disclose in Europe. If we would take the global figures, it would be like multiplied by 3. Same thing goes for the investors that actually have and support the claim for disclosure that the CDP utilizes. And so we're talking about thousands of companies which disclose through CDP, and now actually it is the moment of the year where we are actually collecting the data from companies. If we would go on, Andrea, I wouldn't stick too much here. I would then say like that all of these providers are utilizing in one way or the other the data that CDP is collecting. And the reason why we want this data to be as spread as possible is, perhaps I didn't mention it, CDP is an NGO, so we do not have also the commercial infrastructure to actually spread this data as much as possible. So by utilizing and by partnering up with these providers, we are able to reach as many users as possible. Yeah, next slide. Yes, so here I would go here in the in some of the examples of portfolio alignment and engagement tools that we do have here. So we have something which is called Climetrics, which is actually a partnership with ISS, where basically we rate investment funds. We rate more than 17,000 funds worldwide. And the objective of this is essentially to provide an indicator to retail investors on which would be the funds which are more, let's say, ready towards transition to a lower carbon economy. And we want also to provide a tool to investors to then engage with those companies within their portfolios that are actually lagging behind in terms of environmental performance. The methodology to actually come out with these ratings is pretty interesting, because there's a consideration at portfolio level on the holdings of the funds. So we want to monitor those companies based on, of course, CO2 emissions. So actually GHG emissions. We have water security and deforestation considerations included in the methodology, and we have a materiality coefficient which is set close to those factors. So in this way, by utilizing the Climetrics, it is possible for an investor to identify who is kind of lagging behind, and integrated in the rating, we also provide a score to the asset manager, which is basically built on the on the investment policies that the investor is signed up to. And so this is an excellent tool for at retail level, which was unprecedented at the time when this was created. If we would go on, Andrea. So another engagement tool that we are actually promoting recently, and we're actually having conversations in a post-COVID world. So basically now with other index providers on developing this kind of products, where we basically develop indices, so a family of indices. In this case, we're talking about Euronext, where by utilizing the CDP ratings across the 3 programs of climate change, water, and forest, we were able to create a sort of leadership index. First of all, by starting in France, we then moved to a Eurozone and to a world type of index. And this is exactly, so we have created with Euronext this index where you have this leadership across these 3 programs. And this is exactly what CDP's mission is, because if we take the index, the participants of this index, we would create the incentive for companies not only to participate to the index and not only to disclose. So non-disclosing companies would not be able to participate to the index. So we would want to create the incentive for companies to disclose their environmental performance, so to monitor the environmental performance, and not only to disclose it, but also to have to disclose in a qualitative way, so to have high ratings through CDP. So this would create the mechanism, the incentive for companies to improve their environmental performance. Yeah, next one, Andrea. So this is actually something which is not there yet. So next week we will be able to launch this project. So this is kind of a sort of world premiere that I'm kind of giving now. And basically what this is I mean, it is similar in name to what Andrew was mentioned before. So we will be able to provide temperature pathways of companies. The methodology is really different. Probably we can perhaps talk more in depth on that later. But basically, we will be able, as of next week, to provide temperature pathways, so in degrees of companies, and as a consequence of that, we will be able also to monitor and have temperature pathways of portfolios of companies. Just to briefly mention, you know, how this was built and why we did it. So this was built starting from the IPCC Special Report 1.5. We then integrate disclosure data on emission reduction targets from CDP disclosure datasets. We then translate those targets into ratings per company, and then we assign basically a degree, actually 2 different types of degrees per company. So we would have a scope 1 and 2 degree for one company, and as a value chain degree for one other company. So for the scope 3, essentially. The reason why we did this is because we felt that we need to find an indicator which was more readable for at retail level, for the general public, and to provide a proxy. As I think Vicky was saying before, you know, we need to reason in terms of pathways here. So we want our indicators to be forward-looking. We cannot, let's say, fossilize ourselves like on carbon footprinting of portfolios, for example. That time has gone. So this is, I mean, target data has a forward-looking connotation. So that's why we did it. Perhaps I didn't mention this. This has been done in collaboration with the WWF and the Science Based Targets Initiative. And yeah, I think I'm done for now. Also, in the interest of time, I mean, this is not the real temperature of Amazon, by the way. It's just a dummy. But basically, yeah, you would have it would be highly likely that you have a scope 1 and 2, which would have a lower degree than a value chain emission, of course. And the message that we want to give in this case is that if all companies reduced at the same pace of this specific company, the world would warm by this type of degree. So I would close it here and perhaps discuss. I mean, leave some more time for discussions.
Yeah, and we still have the presentation of Viola. I'm aware that I've been a terrible moderator with the time when it comes to time, but it's the problem when you have fantastic speakers, right? And you've been, anyways, sort of building the all this presentation. So my role might be redundant in the Q&A. So Viola, take your time. You have still your 5 minutes, and if we need to cut the Q&A, we'll do so.
Thank you, Carlos, and to all my previous speakers, and buenos dias as well from Zurich. Unfortunately, I will not be holding my presentation in Spanish either. I probably would have had taken too much preparation to do that. So as the last speaker, I wanted to kind of really take a step back from the discussion and share with you more general observations that I see in the market when thinking about alignment and scenario analysis. In the spirit of taking in what all my previous speakers have said, but combining it with how we see kind of key considerations being made by the clients we, for example, work with. Brief background as to why you should listen to me or why I can speak to that. So I'm part of ISS ESG's climate unit. ISS ESG is a ESG data analysis provider. And I think what's interesting is we grew out of ISS, which is very well known in the proxy world. And the interesting element about that is how can you integrate ESG considerations really across the entire value chain of your activities as an investor. So from analysis, understanding companies, but then also actioning on it, for example, via voting or engagement. But how to think now about climate and scenario analysis. And let me also link it on occasion then with a couple of statistics and what we see in the market. I think, first of all, if you think about what you've heard just now, is to always clearly differentiate between whether or not you're having an impact or alignment perspective or a risk perspective. I would always advocate for looking into both. To briefly say which one, what do those two perspectives say? So one is how are you impacting the world? And the other one is about how the world is impacting you. So just to put that into context, what we, for example, heard from the panelists so far, Andrew put a relative strong focus on risk, and Matteo, for example, put a strong focus on impact. As said, both perspectives are relevant. If you want to understand future costs, that's risks. If you assess alignment, that's impact. And I think Vicky also mentioned that it's very key that you look into this assessment of the alignment. And let me just link that to one very recent piece of regulation, and that is the EU benchmark directive. What is very interesting about that EU benchmark directive is that it lays out in quite some detail how to calculate and construct a portfolio for it to be able to claim a Paris aligned benchmark title. The step that it does not actually look into is looking whether or not all these calculation rules actually result in a portfolio that would be considered to degree aligned. So just to give you an idea of how putting all these information points then aggregate into portfolio and alignment perspective is relatively key. So what questions to ask when you want to embark into this topic? I think one key is to understand right at the outset that you're dealing with uncertainty. You don't know how companies are developing in the future. And also with respect to the scenarios, there are different pathways of how you can, for example, reach the Paris Agreement. So I think when you set out whether or not it's the impact or the risk perspective, it's key that what you're looking for is directional accuracy. So to get a perspective of the spectrum of choices or impacts you might be facing or having on the world. So let's go to the questions that I put on the slide here. One element that I think is always, no, you can stay on the slide, thank you. One question that is always key to keep in mind is what is the time horizon that you're looking at? And that depends, of course, how you want to use the values, but also how you want to understand the analysis. Why is that so key? It is key because if you look at transition scenarios, so how do you transition to, for example, net zero, as Vicky did mention, scenarios differ, and specifically, they become much more ambitious the further out you look in terms of your time horizon. So it's key that you have a fairly advanced time horizon to to look further into that. The other element on physical risk, again, important to look out because a lot of the climate risks will only hit us from 2030 onwards. So you do need to look into the future. And there, just one additional word of insight on physical risks. I think what is always key to look into is there are two perspectives of how you can quantify physical risk. One is what is the physical risks that would have been there in a business as usual scenario? And what is the physical risk that comes on top from climate change? Because in a way, you know, tropical cyclones existed since a while, but now frequency or severity can increase due to climate change. So if you look into these data points, again, you know, look into the time horizon and look into what exactly is being measured. The next element is how a company's performance is assessed. And I think what is indeed key is that you look into the forward-looking elements of target setting, how has the company developed in the past, what trajectory it is in, and what targets is it setting itself. Next step, how to manage accuracy versus granularity. We have spoken about the point of uncertainty in this entirety of the analysis, and that there's uncertainty that is inherent when you look into the future. So what does it mean to deal with accuracy versus granularity? Accuracy is about the probability of the number actually being true and playing out at some point this way. And granularity, in a way, is about how many digits you have after the comma. So one element I would also like to leave all participants of this class with is the more granular the data points, so in a way, the more digits you have after the comma, the more assumptions necessarily went into creating this data point, and the more careful you need to be in consuming it. And that means also in kind of whatever analysis you look into, again, from whatever provider, always also look into the minimum granularity across all data sets. Because in a way, if you have a very, very granular data set for one type of inputs, but a very rough data set for other types of inputs, that will impact, again, very much the accuracy of the number you get out. And that will always be independent of the number of digits that you have after the comma. So I just wanted to put all these brackets behind that, because what I wanted to leave this audience with is an idea of how you can think about the different elements that you're hearing about in this context. We can go now to the next slide. So just, of course, you know, just to give you an idea of what one element can be of how you can do that. Actually, we are a very active participant in the initiative that Matteo just mentioned of the SBTI's initiative around how to calculate portfolio alignments with the WWF and CDP. Actually, I myself also participated in the development of Climetrics on ISS side jointly with CDP. But just to give you an idea of how all of this information can then be aggregated up, we indeed also use CDP as a source data point, among others, but we also, of course, look into companies' report and alternative data sets to aggregate it. And we use that as part of our report on the impact perspective to really look into how aligned a portfolio is. And you can see in terms of how we display results, and that is over a relatively long time horizon and in relation to different carbon budgets of different scenarios, that we think that it is key that whoever consumes the report really understands the development over time and the order of magnitude. Because I think that's, and the last kind of conceptual element I really want to share with this group is, if you speak aloud alignment, you should always think about it, alignment over what time horizon and in relation to what specifically. So that is just a perspective to take into account. Happy beyond, you know, of course, these conceptual points. As you can see, this is an extract of a wider report that looks into risk quantifications as well. It looks into alignment and various company level perspectives. And of course, I'm happy to pick, you know, the more detailed and broader discussion up at any point if that is of interest. And thank you, Carlos, for the time.
Thanks a lot. Thanks a lot, the four of you. This was a very too hot to handle topic, right? But you have done brilliantly. So thanks a lot. And yeah, we can continue offline the discussion. I've seen some questions from the audience as well. So yeah, definitely I encourage the audience to reach to you, perhaps on social media or in person whenever we can do so. So thanks a lot.
Thank you, everyone. Thank you, Carlos, for moderating.